If you're looking to raise money from investors and you've had any success in identifying investors that are legitimately interested in your company, chances are good that they're either going to ask you for a valuation or you'll be presented with a value offer to respond to. Ideally, you can create an auction among multiple bidders and the value will resolve itself. But if not, you have to make an educated guess. Where valuation is concerned, your goal should be to be in the Goldilocks zone. If you're too high in your valuation, you'll scare investors away. And if it's too low, the chances are good you're going to leave a lot of money on the table, and you might still scare investors away. While many analysts go to a discounted cash flow to determine the value of a startup, we find a market-based approach to be more compelling. Market-based approach is more compelling for two reasons. First, a market-based approach can be a little bit less subjective, whereas a discounted cash flow approach relies on forecasts and projections of cash flows many years out into the future. A market approach relies on data for transactions that are taking place right now, or at least have taken place in the most recent past. Many people find that more comforting. The second reason, and I think the more important one, is that investors themselves tend to rely on market-based methods more than they are willing to rely on discounted cash flow methods. When they examine a company as a potential investment opportunity, they are less interested in relying on the projections that you provide them and more interested in understanding what the valuations are for similar investments in the marketplace. While every investor is different in terms of how they evaluate companies, we find that there are a few recurring themes that you should keep in mind to maximize the value of your company in the eyes of investors. First is the strength of the addressable market. Most venture investors are seeking companies that have at least $1 billion total addressable market size. Companies that fail to reach this threshold are much less attractive to potential investors. You can see an example of this in the pharmaceutical sector. The pharmaceutical sector has companies that are called orphan drug companies. They are called this because although there's a disease that needs to be cured, such companies find it difficult to raise capital because the diseases are not widespread enough in the marketplace. Therefore, the market isn't big enough to entice pharmaceutical companies to invest in those markets. In many such cases, the government steps in and provides government funding to fill the gap so that those diseases ultimately can find a cure. Next is the strength of the management team. Investors are keen to invest in management teams that have track records of success in the industry that the company is addressing, as well as success in creating and successfully exiting startups for their investors. An often overlooked feature of a strong management team is star power. Currently, one of the big differentiators between artificial intelligence companies and their valuations lies in whether those teams include people that have previous experience with the big players such as Anthropic, Gemini, Copilot, or ChatGPT. And not just executives in those companies, but investors and board members in those companies as well. Third, investors are very interested to understand what the market validation situation is for the company. To the extent that you've been able to validate the market or service by selling to customers, the investor's perspective is going to be one that they perceive your company to be lower risk and therefore will assign a higher valuation. The company that is already successfully selling their product and service in the market is more likely than not going to generate a higher valuation than the company that is still developing the market is going to generate a valuation that is higher than the company that is still developing its product and service and has yet to sell to actual customers. Finally, investors pay a lot of attention to assessing the scalability of the company. And what we mean by scalability is the ability or the capacity of the company to add new customers, add new revenue with minimal to no additional cost. That's one of the reasons that artificial intelligence companies are so valuable, is because once their core models have been built, they are in effect infinitely scalable. And there's almost no marginal cost to attract an additional customer other than marketing. But determining the valuation is only the first half of the equation. Not all valuations are created equal. And something that we're fond of saying at High Score Strategies is that pricing and terms are dancing partners. Where there's take from one partner, there's give on the other. And valuation in startups is no different. For example, a $5 million valuation where you're selling common stock may very well be more advantageous to you than a $15 million valuation where you're selling preferred stock and giving up anti-dilution rights. It's important to note that a valuation doesn't magically convince an investor to agree with your valuation, but what a valuation does do is empower you to negotiate confidently from an informed perspective. And it will also help you understand when a deal probably can't happen so that you don't spend more time on a conversation than is minimally necessary. If you have any questions about the valuation of your startup, contact us to set up a free consultation.